Assalamualaikum. This video is our group's presentation on financial analysis for the company Jerasia Capital Bhd.
I'm Natasha Najwa and I'll be explaining on the introduction, the company's background and on leverage ratio. Financial analysis is an assessment of a firm's past, present and anticipated future performance. The analysis is based on the firm's financial statements. It focuses on the historical performance to estimate the future performance. It also allows comparison of company's performance over time as well as its performance relative to its competitors. The objective of financial analysis is to identify the firm's strengths and weaknesses so that the company can capitalize the strengths and also take corrective actions in order to improve the weaknesses. The financial manager's role will change due to the technological advances. Financial ratios is the mathematical aids for evaluation and comparison of financial performance. It also looks at the relationship between individual values and relate them to how a company has performed in the past and might perform in the future. The objective of ratio analysis is to standardize the financial information for comparison purposes and to evaluate the firm's current operation. Ratios are mostly used by bankers, investors, and business analysts to assess the company's financial status. Moving on to the company's background. This company is popularly known as Jerasia Capital Bhd and is mainly an investment holding company. The main activity of this company is that it involved in the manufacturing of the fashion apparel. The vision of this company is to be a leading global manufacturer and a dominant Malaysian fashion retailer, conscientiously embracing best practices to realize sustainable values for the enhancement of stakeholders' interest. The mission of this company is to dedicate themselves to strive for the highest quality in all that they do, endeavoring at all times to exceed the customers' expectations and sharing successful outcomes with the stakeholders. These are the brands that are under Jerasia, which are Mango, Trio, Nike, Milani, Charlie, Terra Nova, Ladylike, and also Eureka. Next is leverage ratio. Leverage ratio comprises of three items, which are the debt ratio, the debt equity ratio, and also time interest earned. The debt ratio is to measure how much debt is used to finance the company's asset. The total debt comprises of the current liabilities and also the long-term debt. The debt to equity ratio is used to measure the percentage of borrowing used compared to equity. Time interest earned is known as interest coverage ratio. It is to measure the ability of the firm to meet its annual interest payments. The higher the ratio, the higher is the firm's ability to fulfill its interest obligations. The debt ratio of the company is higher than the industry average. This shows that the assets of the company are heavily financed by debt. This would result in difficulties to raise additional borrowing in the future or when the company is facing insolvency. This might give a bad reputation to the company and will cause investors to have doubt in the company's performances. The company should have an optimal mixture in its source of financing. The company's debt to equity ratio of 120.49% is higher than the industry average of 36.8%. This explains that the company depends on borrowing sources more than equity sources. A high debt to equity ratio is often associated with high risk, which means the company has been aggressive in financing its growth with debt. There is also a risk that a business will not generate enough cash flow to finance its debt. It is recommended to finance capital management from retained earnings. For time interest earned, the company has lower time interest earned, which indicates a poor ability of the company to fulfill its interest obligations. If the company could not fulfill its obligation on time, it will increase the interest rate, which will lead to insolvency risk. In order to overcome this problem, the company should review the dividend policy.
Assalamualaikum and hi, my name is Farah Shaheera binti Azli Shah. So today I would like to present about profitability ratio of Jerasia Capital Bhd. And the first one is gross profit margin. The formula is sales minus cost of goods sold divided by sales amounting 22.65%, which means every 100 ringgit sales made by the company, 22 ringgit of 65 cents of gross profit is generated, which means lower by 8.35% than average, because the industry average is 31%. This is because the company is poor in earning potential, pricing policy, and they're incapable of controlling its cost of goods sold, which resulting in insufficient sales. And the second one is operating profit margin. The formula is EBIT divided by sales, which amounting to 2.40%. It is higher operating profit margin compared to industry average, because the industry average is only 0.9% and the difference is 1.24%. This is caused by the low operating expenses or higher selling price, and the company should review selling price or maintain the cost of goods sold and the operating expenses. And the third one is net profit margin. The formula is net income available to common stockholder divided by sales, which amounted to 0.47. It is higher than average profitability because industry average is negative 1.7%. This can be seen the company is effectively control the cost and providing goods at a higher price than the cost, and the company also efficient management and low cost of expenses and has a strong pricing strategy. And the first one is return on asset. The formula is net income available to common stockholder divided by total asset, which amounted to 0.7%, which means there is very low management ability to make profit from the company investment in asset, because the industry average is 7.5%. And the company asset also costs more than the company profit, which means the company need to reduce asset cost than the usual cost. And the last one is return on equity. The formula is return income available to common stockholder common equity, which amounting to 1.5%. The company's management is above average because the industry average is negative 1.2. Because the company also using the company's asset to create profit, which means this can cause which means the company can create a good image to the potential client and invest to Jerasia Capital Bhd, and also more benefit to common shareholder because it will bring benefit in terms of their dividend. And that's all from me. Thank you.
Hi, my name is Nur Athirah Syahirah binti Nor Azman, and I would like to present about common size ratio of Jerasia Capital Bhd. The share capital of Jerasia Capital Bhd has the same amount for 2018 and 2019 of 82,046,114, which indicates that the company did not sell or issue any of their shares. For foreign exchange translation reserve in 2018, they have negative 0.79% and it decreased to negative 0.49% in 2019. It means that the company still suffered loss, but they are improving in the year 2019 than the year before. Next is retained earnings. In 2018, they have 71,857,182 of retained earnings, and it increased to 73,828,302. It increased by 2.74% due to dividends paid to the owners of the company and profit for the financial year. For deferred tax liabilities in 2018, they have 0.26% amounting to 812,960. It decreased to 0.12% amounted to 365,075 ringgit in 2019. The amount was decreasing from 2018 to 2019 by 51.4%. It was due to differences between taxable income and pre-tax financial income, or when the basis of assets or liabilities are different for financial accounting and tax purposes.
Hello and Assalamualaikum. I am Afifah binti Aznan, card matric number 2017184053. I'm going to continue to talk about the common size ratio. So firstly, I'm going to talk about bank borrowings. For 2018, the bank borrowings are RM 3,166,612, and for which is 1.02%, while for 2019 is 1,166,596, which is 0.34%, which shows the borrowings made by the company decreased from the year 2018 to 2019 by 63.16%, which conclude that the company have paid some of their long-term loan in the year 2019. Next, for total non-current liabilities in year 2018, the amount is 1,561,671, and for 2019 is RM 3,979,572, which the percentage shows that the liability increased by 0.82%. Trade and other payables in 2018, there's 7.88%, which is RM 24,406,363. For 2019 is 11.86%, which is 40,330,726. The trade and other payable increased by 65.25%, which indicates that the company has made several credit purchases, which inclines in 2019 compared to 2018. Lastly, is tax payable. For the tax payable in 2019, which is 491,427 ringgit, which is 0.16%, while in 2019 it is 1,050,507, which is 0.31%. The increase between 2018 and 2019 means that the company has higher sales in 2019 compared to 2018. That's all. Thank you.
Assalamualaikum and hi. My name is Nur Adila binti Rohizir with student ID 2017167709, and I will be continuing with the current liabilities on unsecured bank borrowings. As you can see here, as for 2018, the amount of total current liabilities from unsecured bank borrowing is 129,460,102, and as for 2019 is 142,866,776. This shows that it has increased by 10.36%. That is caused by increasing both bankers' acceptance and the trust received over the year. As for total current liabilities, as you can see, the amount is the same, which is 82,046,114 ringgit Malaysia. This indicates that the company did not issue nor sell any shares. Then, as for conclusion, according to the ratio analysis that has been made previously on leverage ratio, The company should take precautionary steps recommended in the analysis of ratio to prevent the problem from getting worse. This is because, based on the leverage ratio calculated before, the company is said to have been financing its asset heavily with debts. They also have been depending on borrowing sources more than equity sources to finance its growth. Next, the analysis on profitability ratio shows that the management of the company has competent ability in managing their sales volume. This is because the company has low gross profit margin and return on assets. However, as for operating profit margin, return on equity, and net profit margin, it shows a higher ratio compared to the industrial average. This is because the company is controlling its costs and operating expenses efficiently and gives better return to its shareholders. In summary, common ratio has increased by 1.82% from the year 2018. For total non-current liabilities, it has been decreased by 60.76%, while current liabilities increased by 19.36%, and overall common size ratio calculated in 2018 and 2019 shows that the total of equity and liabilities increased by 9.76%. And that is all for our presentation. Thank you.